Well, hi guys, welcome to this Money Control live stream. You're watching Morning Trade with me, Nandita Khemka. Well, it's a busy day on the earnings calendar. Lots of nifty earnings today. L&T, Tata Motors, Bajaj Auto. We'll be telling you what to expect from these companies over the next 30 minutes. And of course, global cues, well, those are fairly positive. GIFT Nifty may be in the red, but given the fact that we shut shop below that 19,700 mark, looks like we are in for a mildly positive start this Tuesday morning. And of course, over the next 30 minutes, we'll also be getting all your stock-related queries answered by our experts on the show. So if you have any queries, send them in to us on our YouTube feed and we will get them addressed. But before we do all that, let's take a look at the top headlines at this hour. Wall Street rallies with the Dow gaining for the 11th straight day. Street largely expects a quarter-point hike from the US Fed's policy meet beginning today. Meanwhile, Asian markets open mixed while the GIFT Nifty is implying a higher start for the Indian market. Crude prices surge over 2% with the Brent topping $82 a barrel. Prices surge amid tighter supplies and as China pledges more support for its troubled property sector. Tata Steel delivers a beat in the first quarter, aided by strong performance by the India business, while the European business continues to struggle. Debt levels also rise due to capex spending. Strength in JLR business may aid Tata Motors' quarterly show. Meanwhile, Asian Paints is expected to deliver significant margin expansion and 10 to 12% volume growth in the quarter gone by. A strong quarter is also seen from Bajaj Auto, with margin expected to come in at record levels. However, domestic volume growth is likely to be offset by flailing exports. SEBI sets the stage for a slew of reforms. Chairperson Madhavi Puri Buch says talks are underway to bring in instant settlement in the stock market. Also says it is exploring delisting through fixed price and will float a discussion paper on the norms by the end of the year. Well, let me get on board our first expert for today. Milan Vaishnav of Gemstone Equity Research is joining in this morning. Good morning, Milan. I think we've spoken quite a few sessions ago. So, of course, we managed to come pretty close to that 20,000 mark. But of course, given the fact that IT earnings have played spoil sport, and as we digest more and more earnings, we've broken below that 19,700 mark as well. But going into today, the setup seems to be positive. We have the US Fed outcome tomorrow. But largely expectations of a 25 basis point rate hike factored in. How is the setup looking like today? And if you expect more downside, what is the kind of support one should be watching out for on the Nifty now?
Yes, Nandita. Good morning to you all and to the viewers. When we talk about the markets, there are so many things that we need to look at for not only for today, but for the next immediate 1 or 2 days. Because the week is going to be full of events. We have, most importantly, we have a monthly derivative expiry that is lined up day after tomorrow. So that is something, the expiry is going to influence the overall trades which are likely to stay rollover centric. That is point one. Importantly, the Fed meet starts today on Wednesday. We have the Fed on Thursday, we have the ECB, and on Friday, we have BOJ. All are likely to follow the suit. But a 25 BPS rate hike is largely discounted for. Now, taking a look back on our domestic technicals, in a couple of interactions with Money Control in the past, I think on this show or elsewhere, I had mentioned that both of the things are likely that the markets will go near 20K, and at the same time, it is going to find strong resistance there purely from a technical standpoint. So that is what exactly has happened. So now, if we take a look at the technicals, what I feel is that 19,900 the immediate high that we have formed has now become an intermediate resistance or the top for the market, and on the lower side, 19,450 to 500 zone is the place where the Nifty has dragged its supports higher. So I feel one thing happening very clearly is that there are no major drawdowns in the market. There won't be any significant decline. But at the same point in time, we are likely to consolidate in a very defined range of 300, 350 odd points, with 19,500 on the lower side acting as support and 19,990 acting as the immediate resistance. So that's where I see the markets. Markets are now getting very stock specific, and by the time it consolidates, and though does not show any major drawdown, I mean, right stock picking will be the key to survive in this technical setup.
Right. Well, those are the immediate support and resistance levels to watch out for on the Nifty. Hold on, Milan. We'll come back and speak about various stocks that will be in focus today. But let me also bring on board our next guest for today. Renu Baid of IIFL Institutional Equities is joining in this morning to talk about the capital goods space and L&T, of course, reporting numbers today. So what to expect from that as well. Good morning, Renu. Good to have you on the show. First things first, L&T reporting numbers today. Stock has run up a fair bit ahead of earnings, and our polls are throwing up a double-digit growth in profit, as well as margins expected to be above 11%. What are your own expectations when it comes to L&T on the profit and margin front? And of course, what are you expecting when it comes to the order book? Given the government's capex push, do you expect order book to be extremely healthy in this quarter?
Yeah. Hi, morning. So when it comes to Larsen, I think this quarter will definitely be pretty strong in terms of execution. We have already seen from the past couple of quarters, government push on execution has been very high. So if you look at Larsen, on the core business, we are expecting almost 22% growth in revenues at about 27,000 crores and EBIT margins improving by 40 to 50 basis points, given that last year's base was also soft. So while infra margins will take some time to recover, just 60 basis point improvement that we're expecting. But overall at the company level, that will definitely translate in 20% plus growth in profits. At the console level, this is essentially 18% growth in revenues and about 30% growth in profits that we see. When it comes to order inflows, typically 1Q is not a very strong quarter seasonally. But given last year also, we had seen some front ending of order inflows, and we expect that trend to continue this year, given it's an election year. So the core order inflows, what we are pegging in is about 35,000 crores of order inflows, which is about 25% growth on a yearly basis. Even if growth is 2 to 5% here or there, it would not be material. We have seen large order announcements like the second leg of the Mumbai-Ahmedabad speed train, bullet train project being awarded recently. So to that extent, the visibility of orders for Larsen is very strong. And that is exactly in line with the broad contours of the market that we are seeing, both in terms of large government sector project awards, seeing material acceleration and front-ending in terms of award during this current calendar year ahead of elections. And that is very well complemented with the private sector capex also, which has sustained its momentum and is now continued to show strength. So to that extent, the order inflow momentum in the market and in the economy remains fairly broad-based. Within infra segments, largely it is water, T&D, rail rolling stock, and core civil infra projects which see strong acceleration. And on the industrial side, we see chemicals, data centers, some recovery seeing in buildings and factories and real estate segment of the market. And even core sectors like metals have continued to see very strong trajectory in terms of project awards. So all in all, it seems to be a continuity of the investment momentum that we saw in the last 6 months, and that gaining traction, especially in the private sector investment space.
Right. The market, of course, will be watching out for the share buyback that the board will be considering today. Would you say that, this will be a precursor to a valuation re-rating when it comes to L&T?
Valuation re-rating, in my view, would more than the buyback, it would also be triggered by how fundamentally the operating performance and the profitability improves. But definitely way back in 2018, Larsen had tried for the buyback, which was rejected by SEBI then. Today, if we compare then, the business is, the balance sheet is far more stronger. They're sitting on net cash of 10,000 crores plus on the core books. And net worth is just about 70,000 crores kind. So it's very much within the given range. And they have been on their course of monetizing the non-core assets. So to that extent, I think the core cash flow from the business operations remain fairly steady. And yes, buyback and reduction of equity definitely helps in terms of improvement of ROE and returns to holders. And that's one of the ways through which company can return back the cash that it is sitting on to the investors. So whether it is special dividends or buybacks, it's definitely a pleasant move which from the market perspective.
Right. Let's shift focus to some of the MNC stocks now, given the fact that, ABB India has been a multi-bagger stock. But of course, last week we saw its global parent giving a pretty weakish outlook. Does that mean it's time to turn cautious on some of these MNC stocks like ABB India, Siemens, Cummins? How would you view this entire MNC basket now?
Yeah, so I think clearly the MNC baskets tend to outperform during the cyclical upturn and the downturn because of the portfolio and the offerings that they have. Now, if you look at the markets and the way the stocks have moved over the last 4 to 5 weeks has been really crazy. Like everyday stocks have been up without really no dramatic fundamental improvement on the ground. So clearly some correction on any softness in the news flows is bound to happen. And when you typically look at a cyclical growth, it's not that the growth is always linear. There could be quarters where growth could be a bit soft. In this case, when you look at ABB here, the parent, when they announce the order inflows, that's in US dollar terms, and there are usually timing differences in the way the group and India report order inflows, especially adjusting for the intergroup company and currency adjustments. So to that extent, the US dollar growth rate of 7% that they reported for India is not very different from the 4 to 7% growth that we are expecting in USD terms. In rupee terms, it tends to be between 15 to 25%. So here the big movement in our assumption could be one large steel order that we have expected from the Greenfield Capex. Whether it's a part of the 1Q or the second quarter or the third quarter inflows is yet to be seen. But we don't see this as a structural softness or a red flag in terms of the Capex trajectory. In our view, it's more of a timing difference of the way the inflows are coming through, because the broad commentary still remains positive. So yes, I think these kind of moments in the market where there could be certain softness or gaps in terms of expectations on order inflows, that in my view is an opportunity to add the stock when it corrects, because when the stocks typically rally one way, for long only investors it's become difficult to add when stocks become too expensive on the valuation front. So some correction definitely adds more sanity to the price and the valuation levels, and ensures that the fundamentals are intact.
All right. Lastly, Renu, are you liking anything in the defense, especially railway pack at the current juncture?
In the defense space, Bharat Electronics continues to be a top preferred pick, given the kind of order book, the free cash, and the working capital that they've demonstrated. Railway, we don't have pure proxy play for rail segment in the market, but if we see Siemens tend to be a good proxy with their exposure to the mobility segment, or even some of the EMS companies that we have in the space, names like Keynes Technology or to some extent Avalon, they have good exposure to supplying electronics for signaling, telecom, braking systems for the railway market. So they become like a tier 2 proxy in this space. But yeah, I think these two segments definitely are more resilient in terms of both orders and the execution. And railway rolling stock is one space where we think is in for a significant upswing over the next 18 to 24 months when it comes to capital expenditure.
All right. So those are the stocks looking attractive in the defense and railway pack. With that, Renu, thanks a lot for taking our time and joining in this morning. It was a pleasure chatting with you.
Thank you.
Well, with that, let's go back to Milan and talk about specific stocks. Of course, stock of the day for me today is Tata Steel, given the fact that the net profit has slumped by 93%, but it has managed to beat expectations, which were somewhere around 162 crore rupees or thereabouts, but profits have come in at 524 crore rupees. So clearly a beat on that front. Revenues, in fact, are also down 6%, but it has still managed to beat the kind of expectations that were doing the rounds. EBITDA margin meets estimates, and the company has said that it's a non-cash deferred tax charge on account of buy-in transaction at the British Steel pension scheme that has weighed in on profitability. Milan, I want to get in your thoughts on Tata Steel. We have a couple of queries also coming in on our feed. Prabhu wants to know, what should be the strategy on Tata Steel post earnings. What would you advise investors to do for these for Tata Steel, especially given the fact that the numbers haven't been all that bad?
Tata Steel has had it has had a good run up from 103 to 104 levels to 119, and we can largely attribute this to the weakness in the US dollar that we saw over the past days. But I think Tata Steel is now in for some consolidation, and anyone who is long in the stock can book at least some 50% of the profits here, and then continue to hold on to that. And so far as taking fresh entries is concerned, it's better if you take or if you take fresh entry into the stock only above 120 and not now.
All right, that's the view on Tata Steel. But let's talk about ITC. Of course, that was the stock in focus yesterday as the board has given its approval for the demerger of the hotel business. We saw quite a bit of a knee-jerk kind of reaction coming in on stock, of course, which had had a fair bit of uptick in the last few months, or in fact, so to say, best performing stock on the Nifty over the last 1 year. But if this morning, if you look at the brokerage view on the stock post the demerger nod, Goldman Sachs has kept a buy rating, target price of 470, and in some of the parts, it has given a value of 12 rupees per share for the hotels business. In fact, it believes that the investment thesis is based on the cigarette-based profitability and the FMCG business profitability. Morgan Stanley, overweight rating, target price at 474, and it believes that the demerger should be allaying concerns about capital allocation over the medium to long term. And if you look at Nomura, that also has a buy rating, of course, target price at 485 per share. And it believes that the value unlocking with creation of a pure play hotels entity is a big positive. Looking at the stock, of course, yesterday we saw, sell-off come in after the news. But would you say this is a good buying opportunity into the stock?
My view or my answer would be different from a short term and for a long term perspective. If you are in for a long term perspective, is ready to hold ITC for a couple of quarters, then definitely it is a buying opportunity. So there are no second doubts about that. But if you are taking from looking from a short-term perspective, from an active investors kind of a view, then there are a couple of interesting things that happened on ITC. ITC stayed in a sideways trajectory from 370 to 400 for almost many months, 3 to 4 months. And once the breakout was achieved above 404, we saw a near linear up move in the stock, which took it to close to 500 levels. So I think from that point of view, you cannot have a linear up move for the rest of your life. So I think from a short-term perspective, ITC, we should be looking at booking profits in ITC and re-enter the stock above 495, 500 levels. And for the long-term investors who are holding it in their overall equity portfolio, may continue to stay invested. Fresh entries at this point, I would not advise. By the time this entire fundamental developments get settled into the price, one should wait and enter the stock above 495. And as I just said, if you are invested for a long term, you must continue to stay put with ITC.
All right, that's the view on ITC. A lot of queries coming in on Reliance Industries. We have queries from Yagnesh, Ashok Kandukuri, as well as Chulbul Singh. They all want, and Money Vanan as well. So 4-5 queries coming in on Reliance Industries this morning. Of course, we saw the company report a mixed set of numbers. And yesterday, of course, there is, this bit of news flow that the company has announced its partnership with Brookfield Infrastructure and Digital Realty to collectively invest in a special purpose vehicle for the development of data centers in India. Now, Reliance will hold a 33.3% stake in each of the SPVs, making it an equal partner in the venture. Of course, stock last week we saw the demerger of Jio Financial Services as well on the bourses. Stock, of course, was under pressure yesterday, but with a long to medium term view, how would you advise investors to approach Reliance now?
From long to medium term view, I would suggest that Reliance should be accumulated with each decline in bits and pieces. Say with every decline, you can go on and accumulate some, or rather buy some small quantities, I'll call it. You can buy some 20% of your total money that you have allocated for Reliance. So one can continue to make staggered purchases with every decline. The stock can be accumulated. It has got good support in the range of 24-20, and that's where I see the stock taking the support right now.
All right, that's the view on Reliance. Then what would you do with the Infosys and TCS at the current juncture for the short and long term? This query is coming in from KSS. Of course, after the sharp guidance cut from Infosys, the IT pack has been roiled, to say the least. even though earnings from TCS were muted and HCL Tech and Wipro weren't all that bad. So how should one approach the entire IT basket now after the first quarter earnings?
I would use this as buying opportunities, because if we take a standalone technical look on the IT was inside the lagging quadrant of the relative rotation graph. So what that meant was that it was supposed to relatively underperform the broader market. But what we saw instead was a sharp improvement in its relative momentum, despite staying staying inside the lagging quadrant, and that had seen some staggering up move happening across the IT pack. So whatever happening right now is IT space is just consolidating. It might continue to consolidate for some more time, but each such instances of some numbers not good as expected, or some lesser guidance on the earnings, and whatever reason, fundamental reasons that is bringing the stocks lower, is supposed to be utilized as buying opportunities. I will continue to expect ITs largely outperforming over a short to medium term horizon.
All right. From IT, I want to bring your attention to the auto space. Of course, TVS Motors reported a good set of numbers yesterday. Stock, in fact, recently did hit a fresh high as well. So how should one approach this stock? And of course, Tata Motors will be reporting its earnings. So there's a query coming in on TVS Motors from Sandeep Reddy. Wants to know what one should do post the results. And of course, Tata Motors will be reporting earnings today. Strong JLR performance likely to aid first quarter show. In fact, I'm just looking for the poll that we have. In fact, revenues are likely to jump to over 1 lakh crore rupees versus 71,900 on a YOY basis. Margins expected to come in at 11.8% via 4.4%. This is a consolidated margin, of course, I'm talking about on a YOY basis. Of course, it's the easing chip shortage, traction towards new models, all these factors to aid JLR volumes as well going forward. So, these two stocks, Tata Motors and TVS Motor, how would you look at these companies, these stocks?
Right. Let me first begin with the TVS Motors. TVS Motors, it first marked its high point of around 1351 sometime in June, 9th of June this year. And since then, it has been moving in a sideways manner. And yesterday, it has seen itself closing a notch below 50-day moving average. So this was the 50 DMA was the linear support line for the stock right now. So, and it has slipped below that. So I feel that if you are a short-term investor in that, perhaps this is the time that you book your profits in TVS Motors and wait for the stock to go above 1360 to re-enter it. So unless the stock goes above 1360 again, perhaps it's time to leave TVS Motor right now and move your money elsewhere. It's time that we protect our profits, because with the stock slipping below the 50 DMA, I feel that some consolidation or some corrective retracement might continue in the stock.
Right, that's the view then. Let's also talk about Aarti Drugs. One query coming in from Meera Patil wants to know what to do, with the stock, given the fact that the company has, of course, announced a buyback. Is it the time to book profit or buy more? This is one query. And one last query on AB Capital. Bikram Murmu has been writing in for quite some time. I want to take it up. He wants to know your thoughts on AB Capital for the short term. So, Aarti Drugs and AB Capital, these two stocks.
Right. Let's begin with Aarti. Aarti had got a huge up move yesterday, almost a strong gap up. And there are two set of answers to this. One is that should we be buying more? I would say no, because the stock is now deeply overbought, and at any point in time, some consolidation might set in. So fresh entries into the stock might not come with a good risk to reward ratio. So buying more in Aarti Drugs is not advised. If you are long, continue to stay long and trail your stop loss to 595. If the stock slips below 595, perhaps you can book your profits and exit from the stock. So that's my view on Aarti Drugs. And moving on to AB Capital, I believe.
Yeah, that's correct. AB Capital.
Yes. AB Capital, if you are already long in it, continue to stay put. continue to stay long, maintain a stop loss of 180 on the stock. If you are planning a fresh entry, you can enter a fresh, but again, keep a stop loss of 180 on the stock.
All right. Well, this wraps up our query segment for today. We are running out of time, but Milan, before I let you go, stock recommendations for viewers this morning.
I'm looking at ONGC and Bank of Baroda today. ONGC, one can buy above 171, expect the targets of around 178, 179, maintain a stop of 166 on the stock. Bank of Baroda is the second stock I'm looking at. One can enter Bank of Baroda above 200, not at the closing price that we had today. Above 200, the call will get triggered above 200. I repeat. Bank of Baroda above 200, that 215 is the target that we expect. One can maintain a stop loss of 192 on the stock.
All right, those are the stock recommendations coming in from Milan Fast for our viewers. With that, Milan, thanks a lot for taking out time and joining in this morning and sharing your thoughts with us. Well, with that, we're completely timed out on this edition of Morning Trade. From me and the entire team, thanks a lot for watching, but don't go anywhere because coming up next is Opening Bell. Stay tuned.